Anastasia Amoroso, Chief Investment Strategist at iCapital. Welcome to our third quarter alternatives update, or as we call it, Alternatives Decoded. Today, we will discuss key developments and our view on private markets, as well as structured investments and hedge funds for the rest of the year. And specifically, we will cover the latest analysis in private markets data, key market trends, and leading economic indicators that are shaping the direction and investment outlook of these alternative assets. And I'm very pleased to say that to help me do that today, I'm joined by my colleagues, Kunal Shah, who is the head of private asset research and model portfolios, Joe Burns here to my right, head of hedge fund research, and of course Pete Horacek in the middle, who is the head of structured investments distribution. So we're going to plan to talk for about 40 to 45 minutes. We've got some prepared remarks, but of course we would love to hear from you and answer your questions. So if you'd like, please submit your question at any time in the Q&A box in your Zoom screen. We will get to them maybe throughout the conversation, or if not, we're going to address that in the last 15 minutes. So with that, let's get started. And I want to set the stage, and I want to talk about the growing importance of alternatives as an asset class. And if we look at this first slide, which is actually a map of the world according to the regional breakdown of alternatives, you'll see, first of all, that this is about an $18 trillion asset class today. So it is very sizable. And it's also broken out regionally. About 61% of the asset class, of the assets invested within alternatives, are in North America, about 20% is in Europe, and about 17% is in Asia Pacific. So some North America dominance, but nevertheless tremendous opportunities in Europe and Asia as well. And also what's interesting is that $18 trillion has now become a sizable portion relative to the more traditional asset classes, about 23%. So let's look at the rate of growth that we have seen and what's expected. And if we flip over to the next slide, we'll see that alternatives have grown significantly over the last, call it 14 years. For example, in 2010, the asset class was just $5 trillion, but you look at it today, we've seen 3- or 4-fold growth within all different categories of alternatives. But I don't think we're going to stop there. And according to the industry forecasts, we're looking at $24.5 trillion that is expected to be the AUM of alternatives by 2028. Now, we are seeing growth across the different categories of alternatives, including private equity, for example, growing about 9%. And then you can see on the right hand of the slide, private credit actually is expected to have the fastest growth of all of those, of about 11%. So more growth to come in several years ahead, but let's talk about the current market conditions. And if we flip to the next slide, let's look at the fundraising that we've seen within the alternatives landscape. And obviously, it's been a great year, 2021, but since then, the fundraising activity within alternatives has slowed. But I will say that when we look at the run rate of fundraising so far for the year, project that out through the end of the year, about $1.1 trillion that is expected to be raised within alternatives, and that is roughly on par. We're getting close to what we saw in 2023. So I think there is a degree of stabilization that we're starting to see. Private equity, private credit, infrastructure are actually seeing an upturn in fundraising year to date, year over year. So the other way to look at what's going on in alternatives in terms of current activity is to look at deal activity. And if we go to the next slide, there's actually been a very significant pickup in deal activity when we project that out for the full year. So the run rate is expected to get close to $2.4 trillion, which would actually exceed what we saw in 2023. Now, we'll discuss more with Kunal, for example, but I think a lot of that makes sense because, first of all, there's a tremendous amount of dry powder that's been sitting there, about $4.3 trillion across all the different strategies globally. And so I think there's the eagerness to put some of that to work. And of course, you need a catalyst. And today we do have more certainty about the economy, valuations, and now the direction of rates. So it makes sense that we're starting to see that uptick in activity, deal activity. Now, the last thing I want to say in this overview is let's talk about performance and look at the historical look at alternatives performance. Now, it's too early to talk about year-to-date performance because, again, as Kunal will tell you, those returns get reported with a very significant lag. So we'll know the true performance here in the next few quarters. But if you look at just the Q1 number, you'll see that the 60/40 portfolio at the time was up about 4%. Well, now it's double that. But you'll see that infrastructure, for example, as well as hedge funds, did actually outperform the 60/40, and some of the assets, also, the other sub-asset classes also delivered positive results. Now, I think importantly, the four most important columns on this quill chart is if you look at alternatives performance over a 3-year, 5-year, 10-year, 15-year time horizon, and if you look at that dark blue rectangle box, which represents a 60/40 portfolio, you'll see that all of the boxes above that represent a different type of alternative, different categories. So starting with buyout, growth, secondaries, private credit, all of those have delivered performance over the last 15 years that exceeded the 60/40, which brings us here today, which brings us to our discussion today. And this is why we wanted to have the conversation with my colleagues today to dive deeper into the various alternative sub-asset classes. And so let's do that now. And Kunal, I want to come over to you because, of course, one of the largest asset classes within alternatives is private equity, and we've seen that it's performed quite well. But tell us from your perspective, big picture, why should investors care about private equity?
Yeah. So as you pointed out, Anastasia, performance is one of the biggest reasons private equity matters and why people should allocate to the asset class. But what is driving the performance, right? You have to look into why you should allocate to this. And so as you see on this slide, the number of available companies in private markets continues to grow. Compare that to public markets, it's a flat line, right? In fact, it's declining in public markets. The second point attached to that is, in public markets, you have the same set of information. Everybody will get the same information, which means that you have no information advantage when you're evaluating a company. In private markets, every company will share a different set of information because there is no standardized template. They are not required by SEC or any other regulating body. That means that a skilled investment manager is able to drive alpha by capturing that information and keeping that information themselves and using that to create value for them. On my earlier point, the number of companies, if you just think about the number of companies available in the US, over 85% of the companies that are over $100 million of revenue are privately held. Vast majority of them are in this sort of what we call the middle market segment, which is growing at 2 or 3 times the GDP rate. And most investors, by not participating in the private equity landscape, are missing out on that opportunity set. If you go to the next slide, we talk about the performance creation, right? And so one of the things I said earlier is, if you have information advantage, you got to put that in practice. And what private equity guys do better than anybody else is they're active owners of this asset class. They own these companies outright through controlling positions, and they drive value by improving margins and improving revenues. Very important part of the value creation. If you rewind this 40 years ago, private equity was more of a capital markets driven opportunity. Buy company, add some debt, and hopefully it will at a much better valuation. Those days are gone. Today you got to come in, improve revenues, improve margins, and that is a really important playbook to create value and returns, to your earlier point.
All right. Well, speaking of returns, they have been significant in private equity, but they've also been significant in public markets. I mean, you look at the global 60/40, you look at the S&P, you look at the NASDAQ, very strong performance year to date and last year. So against that backdrop, Kunal, why should investors still be thinking about private equity when maybe you can just stick with public?
Yeah. So let's dig into that. Let's go to the next slide, right? And so what you will see here is the consistency of private equity. So if I'm thinking about putting my own money to work, what I'm looking for from an asset class is consistent performance, where you can rely on that, and that creates a very stable element to my portfolio. If you look at this slide, private equity has had only one down year in the last 20 years. That's amazing. You have gone through multiple cycles, but private equity has done its job in delivering positive value to your portfolio. I'm even more impressed by private equity's performance during negative public market returns. That's 2008. That's 2022. The outperformance of private equity is significantly higher in those years. What tells you that in down years, it provides a stability in your portfolio, and in up years, it will capture some of the same upside that public equity experiences and sometimes exceeds that. So that's a very important part of how you should think about private equity performance against public markets. On the next slide, one of the reasons why we think this outperformance exists is the consistent ability to private equity to buy companies cheaper than public markets. One of the simple investment mantra is buy low. I'm not saying private equity is low, but private equity is cheaper than public markets. And as a result of that, if you are able to buy companies at a lower valuation, fix the company or improve the companies, like I said earlier, improve the margins, improve earnings, that will allow you to sell the companies at a higher valuation, whether it's an IPO market or a strategic buyer. A strategic buyer, when they're looking to buy a company, they're looking to look at the same public market comparables as part of their transaction processing. So really strong value can be captured in private equity, and that's partly why it's consistent outperformance of public markets. If you go to the next slide, we can talk about some of the trends that we are seeing, but the exit activity has picked up as well. And a really important part of private equity, because now you can bring that money back. And we have talked about this before, you and I, which is how do you think about exit markets through IPO or strategic acquisitions as well?
Right. And of course, for buyout private equity, the strategic M&A, the corporate M&A is really, really important. But for some of the venture companies, for example, the IPO market is really important. And like one of the things that you see on this slide, much like the deal activity is recovering, we do see the first innings, perhaps, of the IPO activity recovering as well. For example, when we look at certain measures, or what we call the IPO barometer, that looks at confidence, that looks at multiples, et cetera, it has picked up quite significantly given where we are in the economy. And so we are starting to see some uptick in IPO volumes as well. So Kunal, thank you for touching on the very important asset class of private equity. And I want to extend that and talk about private credit and the important role that private credit plays in some of those private equity transactions. So first of all, if we go to the next slide, and if we look at this big shift that has been playing out, the big shift is that more and more sponsors, more and more issuers of loans have been relying on non-banks to get that issuance. So for example, back in 1994, you had something like 75% market share that banks represented. Well, that dwindled to the 5-year average about 15%. It picked up slightly to about 25% recently because there has been more issuance of broadly syndicated loans. But I think the long-term secular trend is still very much intact, which is, take a look at the light blue line, and you'll see that the non-bank share of financing has increased to about 75%. So I think that continues given the stringent regulation that we've seen around the banking sector, given the capital requirements that we've also seen around the banking sector. So a lot of the middle market loans have to go look elsewhere for the backers and the issuers, and that is part of private credit. Now, when you think about private credit, some investors might say, well, this has been an asset class that has been well talked about and maybe well trafficked in by some investors. And now some actually worry about not the future growth, but there might be too much dry powder in the asset class already. And if we go to the next slide, I want to debunk that myth a little bit, because everything is relative, and we have to look at the private credit dry powder relative to private equity. Because if a private equity company wants to do a deal, and as we know that dry powder has to be deployed, chances are they might turn to their private credit partner to actually underwrite that loan. And so what you see here is that the ratio of the two measures of dry powder has actually stayed pretty constant over the last 4 years or so, averaging 22%, give or take. So I would argue, given the secular trends that we mentioned before, companies do also prefer to go to private credit providers because you can get more bespoke terms, you can get more flexibility, and so that's why even though market share of private credit dry powder picked up a little bit, there's still very good reasons for that trend to stay intact. Now, that's from a company perspective. That's why you might go to the private credit provider. Now flip to the next slide, and let's look at it from the investor perspective. Well, investors in direct lending have been rewarded quite nicely over the last 10 years. You'll see, for example, that the direct lending returns have averaged about close to 9% with volatility of about 3%. compare and contrast that to the leveraged loan market and the high yield market, and we do see lower returns and actually higher volatility. And then on the right-hand side of the slide, you'll see that the same trend is also forecasted for the years ahead, with direct lending outperforming in risk-adjusted terms. Now, I'm sure the other thing you might be thinking about on the next slide is, well, private credit has been a great place to be when the Fed was high for longer or higher for longer. And what happens now when most of the private credit is actually floating rate and some of those rates may be resetting lower? Well, first of all, investors have enjoyed a very nice yield of around 12% in private credit. And yes, if the Fed funds rate declines, the income component of private credit will also decline. But this chart is interesting because it looks at the composition of private credit returns. It looks at things like the LIBOR floor, the 3 months LIBOR, the leveraged loan spread, and then on top of that, the direct credit, the direct lending spread, and that's the light green portion of this. And so what you'll see is that light green portion has been a little bit slimmer in recent quarters because of how high the Fed funds rate has been. But if you go back and you look, for example, since the financial crisis and until COVID, when rates were low, those spreads tended to widen out. So this chart also tells you that on average, for these observations, about 20 years worth, we've seen a spread of about 500 basis points over lev loans. Maybe we don't go that wide, but that spread should nevertheless continue. Now, Kunal, the last point I wanted to make is on defaults. And I'm sure that's a question that's a lot of investors are asking as well. And when will defaults come? When will they end? Well, first of all, the default cycle has been ongoing in private credit. And you can see that on the right part of this page. You'll see that whether you're sponsor-backed or non-sponsor-backed, defaults have picked up. But, well, there's two things that you'll see here. First of all, that sponsor-backed default rates have tended to be lower. And the second point is both of them have actually inflected lower already. So default seems to have peaked and are starting to come down. To me, that makes a lot of sense because if you look on the left part of the page, you'll see the interest coverage ratio that was really high going into the Fed increasing interest rates. It's declined a lot. But if we allow ourselves to think that interest rates are going to go down to 3.6% by the middle of next year, as the market forecasts, you can see the improvement in some of those coverage ratios. So with that, Kunal, I think there continues to be a great structural opportunity in private credit, and I do think conditions are still ripe for private credit investments. Anything you want to add to that?
Yeah, just a couple of things on this slide, which is the reason the defaults are low for two reasons in my mind. Mm-hmm. One, private credit lenders are underwriting companies with the intention to hold through maturity, which means you're doing a different level of diligence compared to public markets where you're actually owning to syndicate. Like you originate a loan and 6 months or a year later you want that off your books. Very different mindset, right? So that's one piece. Second is the quality of companies. You are buying companies that are much better from a cash flow margin perspective. You're investing in asset-light businesses, whether it's healthcare, whether it's technology. Those businesses are able to withstand a much higher rate environment because they have the cash flow attached to that as well. And as a result, we haven't seen significant amount of default activity picking up.
Right. Right. So Kunal, thank you. And we are going to shift the conversation now to public markets, Pete. And we talked about the equity continuum with private equity and the rates component with private credit. But the other big growth area within alternatives is actually structured investments. And when you think about a structured note, it is usually tied to an underlying, which might be a stock, might be an index, but it's a public market asset. So talk to us about the value proposition in structured investments today.
Yeah, thanks, Anastasia. I think that, as you said, structured investments are an alternative and innovative way to access public market returns. And why are they special? Well, they're special because they allow investors to express a view and to define their outcome. They're highly customizable, so you can actually create a product and trade it pretty much the same day. In addition, though, and most importantly probably, is their ability to provide protection on an asset class or an index. Investors are worried the markets run up here. Mm-hmm. Is there going to be a soft landing? How can I really participate in equity markets and also protect my downside? So we offer different levels of protection on structured investments. It could be full, partial, or contingent. And in fact, about 95% of the notes done on our platform have some level of protection. As you can see in the graph here, which reviews kind of the different levels of protection, full, partial, and contingent.
Right, so that's definitely a key component of structured investments, and I can imagine, the higher the markets go, the more appetite increases for different types of protection. I'm sure we've seen that in some of the flows on our platform. But Pete, the other question is, just to level set, what are the key two types of structured notes, and what do they do in the portfolio?
Yeah, it's really growth and income, right? For growth, you're going to mitigate risk, and you want to still participate in those the market upside with some downside protection, maintaining that long equity exposure. And they're also a compelling income alternative. So you can actually structure these to create monthly or quarterly income, basically trading the upside or the return for monthly or quarterly coupon payments. And really, just to dive into the components of a structured investment, there's really four components in it, right? There's the underlying, so you need to know what underlying you want to base your return off of. It could be one, it could be many. It's the maturity of term, and usually these are 1 to 5 years in maturity. It's the protection level, which I spoke about. Do you want full, partial, or contingent protection? And then the upside. Do you want it framed, or do you want it in a coupon format, or do you want it in a growth format? All of these components can be used as levers. So you could change these, you can solve for one of them if you know 3 of those, and really define the product, define your outcome when you create the product, I should say. And here we see examples on this chart of payoff structures for both a growth note and an income note.
Right, and it's very helpful. And Pete, let's talk about the growth of the market. One of the things that we are able to do is track some of those flows on our platform. And so here, let's pull up a chart on the next slide here. But we've seen pretty significant growth in the market. So talk about the extent of it and maybe why.
Yeah, this chart kind of looks at our platform, and about 65% of the flows in the U.S., the sales come through the iCapital structured investment platform. In the U.S., about 120 billion in sales last year, and it could go up to about 200 billion this year. Why? It's really driven by these higher markets and the role or the callability. These notes get called out, they come due early, and they're getting reinvested in these same type of investments. Also, we're seeing more and more advisors and firms looking to differentiate themselves in the marketplace. So we've had a tremendous amount of inquiries from advisors looking to add these to their portfolio. So our platform can educate advisors and offer different monthly offerings for them to access. And along with the advisors coming on, we've had a lot of new buyers in the past couple of years dip their toe in the water with structured investments.
Right. And, there are a lot of terms when it comes to structured investments, different types and different terms that are associated with, but there's some key market variables that drive how those terms price. And so can you walk us through what should we be watching in terms of market variables and the impact?
Sure. This is, if you one takeaway here is this chart. There's really 4 main market variables listed here, and it kind of goes through their impact on pricing. And the first one is higher interest rates, and this is kind of the environment we've been living in for the last couple of years. So when you have higher interest rates, your top global banks that offer these products have higher funding levels. And when you have higher funding levels, you have a lot more money left over for the option package that really is attached to the index and creates this return. So when you have higher rates, you're going to have a positive impact on pricing. Volatility, we've really been in a low vol environment for a long time, historically low. We've seen spikes in the last month or so on days where you get some high volatility in 2-3 day periods, but it can affect different structures in different ways. So if volatility spikes and you're looking to create an income type product, put premiums are going to skyrocket. So you're going to get paid more to sell that put and create that monthly or quarterly income stream. On longer dated growth structures where you're buying calls, that option premium is also elevated. So you're going to pay a little more for that. So it'll negatively impact the growth notes on those type of structures. Credit quality, relatively straightforward. We've been in a great credit environment. Banks are pretty healthy, past the stress test with flying colors. But if they were to show any weakness here, you would have better pricing because the thought would be it's a less safe credit. And then correlations, right? We've been in a relatively high correlation environment where assets are moving together. We recently see the dispersion, the broadening out and the rotation. So correlations really have decreased, and we have decreased correlation. Assets aren't moving together, a little more risk in the return. What are you going to get from this payoff? So you'll have better pricing with lower correlations, a little worse or negative pricing on higher correlations.
Right. This is a really helpful overview, and let's look at some of the market variables. But actually, on the next slide, let's, to put this in action, the left-hand chart talks about or looks at how the growth note volumes fluctuated versus the income note volumes, and so you could see the spike in growth. You can kind of see the tapering off in growth. And anything you would add to that?
Yeah, no, it really goes back to rates. So if you look at 22, 23 in this high rate environment. They help all structures because there's more money left over, like I said, for those option packages. And what we hadn't been able to price growth notes on principal protected product in probably over a decade, because as Joe mentioned, you had interest rates at zero, so there was no money left over. So what you saw is that spike in growth, 22, 23, that was really driven because I could create a principal protected note on an equity underlying, full principal protection with either uncapped upside or a very high cap. So that really drove the market in growth structures. But as you can see on the chart on the left, income payoff, the profile's really taken off a little bit here. And the reason why we hit 38 days, I think this year, year to date, where the S&P hit new highs. So again,
still a lot of days left.
A lot of days, right? So the forward-looking expectations may be a little muted for equities, right? Little more uncertainty. We've got the election coming up. So these income structures really become compelling. Why? Because like on that chart we had before of the example of the income note, I can clip maybe an 8% coupon and still make money in a declining market, because the coupons are pretty much contingent on equities not falling maybe 20 or 30%. So if you have a mildly negative equity environment, I can clip that 8% coupon, and if the S&P, if that's the underlying, was negative 12%, and you're clipping that 8% coupon, your relative performance against an index like that is going to be superior over time. So those income notes really look compelling right now. Plus, we're going to have rates falling, right? So as the Fed cuts, you're going to have CDs and money markets coming in. So I would expect these income notes to really pick up, continue to pick up.
Right, and just a last quick look, Pete, we're going to fast forward through the next slide, but let's go to slide 27. Here's a look at where the volatility measures are, where the correlation measures are. So talk to us maybe about some real life examples of how these are impacting pricing. What do you think is going to be really, really important going forward for the pricing of structured notes? Yeah,
as we said, I think the rates are going to come in, right? So we're not going to have that lever to pull
starting next week,
like we had in the past. So we're going to look to probably correlation, and we're going to look to volatility, right? So we've had those the spikes in volatility during the month of August and here in September, which improves pricing because the option premium increases, and we'll be able to really get better terms on those notes. We'll have very busy days when advisors calling in when taking advantage of improved terms and improved entry points in addition to that option premium. So that's what we're seeing. So that the volatility with the election coming up and everything, I think we're going to see more of those spiky days. And like I said before, on the correlation side, the slide on the right, you see that dispersion. You see correlation on S&P and Russell, and S&P and Dow Jones, two very popular pairings on the lesser or worst of side on the income products. Really the correlation coming down a bit, so we should be able to get better terms there. So the game is changing a little bit. In that example, you could add a third underlier, which would increase or decrease correlations as well, provide higher pricing. So we're going to have to pull different levers, I think, moving forward because of those rates.
So it's not just about rates, but it's about volatility and correlation. And I'll tell you what, when volatility spiked to, 45, maybe it was 65 intraday at one point, I certainly called my advisor asking what kind of structured notes are being priced. Thank you, Pete. And speaking of volatility and correlation, Joe, those are the two words that are really familiar to you in the hedge fund realm. And so let's talk about hedge funds. And we're actually not going to talk about the high beta stuff right now. We're going to talk about this notion of diversification and how it's been lacking using traditional diversification tools like long-term bonds, for example. So where do hedge funds play a role in helping diversify a portfolio?
Great to be with you as always. In terms of hedge funds, when we speak with advisors, which we do very regularly, there are three core components of any well-constructed portfolio. How do I generate returns? How do I protect my client's capital? And how do I be diversified? So the return generating component, some hedge funds fit that bill, certainly private equity and growth notes. The capital protection and income, private credit and income generating notes. The diversification piece, we think of real assets, infrastructure, certainly hedge funds, which can do each of those three things. But I think for most advisors, at the front of one's mind is the diversification of hedge funds. You can see this slide here, which just shows the relationship between traditionally traded securities, stocks and bonds over the last 50 years. Up until very recently, the far right side of this chart, stocks and bonds have been negatively correlated. And that sort of stands to reason, right? When rates are at zero, the only real reason to own a traditional fixed income is as a flight to quality asset, right? So you have this automatic diversification between stocks and bonds. What has happened over the past couple of years, however, is that the relationship between stocks and bonds has turned almost 180 degrees from perfectly negatively correlated. So you have all the diversification you need, just owning something akin to a 60-40, to a completely positive correlation every time equities have fallen, bonds have fallen. So if you think of 50 years of history as sort of a reference point, the likelihood that that positive correlation, and it won't happen every month over the next 20 or 25 years, but I think long term that persistence of stocks and bonds behaving similarly is arguably quite high, at least the historical data would suggest that. And then hedge funds have been able to provide that diversification and new return source for client portfolios.
Right.
If you think of the next slide.
Speaking of returns, right?
Yes, exactly. So the diversification piece is certainly helpful, particularly, as Pete mentioned, in a higher volatility, lower correlation type of market environment. How have hedge funds performed historically? And you see data here over the last 20 or so years, each of the major hedge fund categories having outperformed on a risk-adjusted basis some combination of stocks and bonds. Now, I think importantly, over that 20-year period, rates were below 2.5% really the entire time up until maybe the last 18 or so months. They were actually anchored at zero for much of that time. Now, when rates are below 2.5% or at zero, not a necessarily conducive or constructive environment for hedging strategies, right? Risk assets are on sale. We've talked about the S&P 500 as a proxy being up 8x over 10 to 12 years coming out of the financial crisis. Bonds provide that diversification. Yeah. So it's only recently where the increase in rates to where we are today, well over 5%, has really positioned hedge funds to be that diversifying source inside client portfolios, certainly relative to bonds.
Yeah, and Joe, of course, I'm glad you brought up rates. They were increasing, now they're going the other way, right? So obviously during the times of rising interest rates, high for longer, things like macro hedge funds have done really well, or multi-strat has done really well. But I mean, how should we think about hedge fund performance in a declining interest rate environment?
Yeah, no, it's a great question. So what we do here, Anastasia, we've talked about this slide quite often, looking back over 30 plus years. How have hedge funds performed during periods of higher and lower rates? And you can see on the far left part of this chart, almost 800 basis points of outperformance. This is the average hedge fund. So not factoring, as Kunal and I discuss often, the interquartile spread within different alternative strategies. Just the average hedge fund has outperformed dramatically when rates are above 2.5%. So I think that's a great starting point. Why have hedge funds performed better when rates are a little bit higher? You value an equity very differently. The growth projections, maybe one doesn't have quite the same confidence level that the growth will be achieved. How do you assess the credit quality of a corporate? You look at commodities, you look at currencies, you look at the shape of the yield curve. There's just a lot more ways to make money in a non-directional way when rates are higher as opposed to an environment when rates are zero. So now rates are very likely to be going in the other direction. I think for hedge funds, that's absolutely fine. We've been through higher and lower interest rate environments over the last, in my career, 25 plus years. It's not the declining rates that are the problem. I think it's the anchoring of the rates at a very low base that sort of dilutes the positive impact that hedging strategies can have. So let's assume for a second that the Fed starts a Fed rate cutting cycle next week. Bank of England started that, I think, last month, and I think all bets are on.
The ECB cut today.
Exactly.
Again.
Yes. So it's indeed exactly. So it is here. I do think discounting that rate environment globally, now here in the US starting next week presumably, it will likely create degrees of uncertainty and volatility, right? We're back in what I would think of as a normalized environment. Remember we came into this year, we talked about 6 rate cuts. We're now mid-September, we've had none. We're gonna have some next week. There'll maybe more, how much and at what pace. So there's just a lot of uncertainty with respect to central bank activity that typically yields higher levels of volatility across asset classes, which for hedge funds creates opportunity. So I think as rates, if the Fed is successful in cutting rates slowly and steadily over some period of time, that will continue to create differentiation and opportunity for hedge funds. If, and I don't think this is our base case, but if the Fed is, let's say, behind the curve and needs to act a little more quickly, then you look at periods like the start of 2001 or the fall of 2007, when the pricing of risk assets fell dramatically. So in that environment, having non-correlated strategies, the value there goes up parabolically. So I think hedge funds can drive differentiated returns in a rate declining environment. And if the environment gets a lot worse, a lot quicker, that's not what we are expecting. But if it were to happen historically, hedging strategies have provided a lot of value, certainly against the backdrop of a tough environment for risk assets.
I mean, Joe, this is really kind of a critical point and maybe a bit of an aha moment, because when you look at public markets and how they behave around the pivot points in central bank policy, to your point exactly, well, first of all, during the half of the observations, they behave fine because you don't have a recession. During the other half, they don't really behave fine. They sell off pretty dramatically. But one interesting thing that we found is that when we look at defensives versus cyclical stocks in the S&P, for example, the defensives outperform regardless of whether you have the recession or not in the 3 months leading up to it and the 3 months or 6 months even leading after it. Because whether we ultimately have a recession or not, I think it's this fear of maybe we're going to have a recession that's going to keep investors more in the defensive posture. So sounds like hedge funds can certainly play a role there. Joe, just real quick on the next slide, maybe highlight this, the most interesting observations to you right now about either dispersion or the equity correlation that we see in the market, and what does this mean for hedge fund returns?
Yeah, Pete hit on this earlier. Dispersion really is just the range of outcome, and correlation is just the relationship between different securities, right? So when the range of outcomes are tight and correlations are high, not really a high need to hedge a client portfolio. Clearly what we've seen here is the chart highlights over the last 10 years, the dispersion of the range of outcome has steadily expanded while correlations have declined dramatically. So in that backdrop, having access to more diversifying strategies adds value. It really is more a testament as much as anything to active management, right? Which is, in traditional assets, and I think can add a lot of value in the structured investments area as well. But if you think of how private capital managers, as Kunal alluded to before, hedge fund managers, they're sort of the quintessential active managers. Hedge funds specifically, long, short, global, increased risk, decreased risk, fundamental, quantitative, top down, bottom up. There are just more ways to make money. So when dispersions are wider, correlations are lower, that is a great environment for non-correlated strategies, including hedge funds.
Right. Thank you for that, Joe. And we're going to segue back to the private markets now, Kunal. And we do actually have some questions coming in. We're going to answer them in just a little bit, in 5 minutes or less, on real estate. We've been holding real estate for last, and we imagine there might be some questions about it. But just real quick, Kunal, maybe in a couple of minutes, give us the key points. Why might investors also want to look to infrastructure right now?
Yeah. So we talked about defensive postures and defensive positions. No better way to play defense in my mind than investing in mission critical assets, investing in your local power plants, waste management system, water system. One of the reasons that those assets are really important and they really produce high quality returns for you is the correlation. They are negatively correlated to 60-40. That's very powerful and it gives stability in your portfolio.
In that box there on the left-hand side.
Exactly. And then you add to that, on the right-hand side, is the low volatility of the portfolio, right? And so when you see that compared to other asset classes, they consistently perform, right? So one of the things that we like about infrastructure is they not only protect you against the overall portfolio, but they also are more consistent, more reliable, similar to my comment earlier about private equity as well. If you go to the next slide, right, they're also they're highly correlated to inflation. They produce actually better returns when the inflation is higher, right? And so that's an important part because they are able to collect additional inflation premium in the returns and pass it on to consumers. People are not going to cut back on their power spending. They're going to continue paying their power bill, and as a result, power generators, will be able to continue producing the returns as well.
Right. And really quick, is there something in the economy or geopolitics that's also making this even more compelling today?
Well, if you look at the next slide, I mean, you can see the amount of spending needed globally across infrastructure is massive. And as we all know, governments across the world, especially developed markets, are hamstrung because many of them don't have the capital or balance sheet flexibility to continue funding it. Creates an opportunity for private investors.
And no more zero interest rates.
Exactly. And if you go to the next slide, right, in the interest of sort of moving along here, that is an opportunity across different markets as well. Many of the opportunities in the US, Europe, developed markets, the OECD countries is there, but you can also see the same opportunities in emerging markets where they really need to catch up. And they're trying to catch up, but they still are significantly behind from a funding perspective.
Right. But what's interesting on this slide is that it's actually the Americas, is the United States that leads, maybe not in a good way, the way in needing to fund that infrastructure. There's sort of a largest funding gap in terms of percentages, whereas, for example, Asia has invested quite a lot in infrastructure, and it's been a big focus for Europe as well. Okay, so we're approaching the Q&A portion of our live webinar, and we're going to get to that in just a second. But I do want to close out. So if you'd like to submit a question, please type that in your Zoom box. But I do want to close it out with obviously the last, but certainly not least, and a very important asset class, which is commercial real estate, which represents about $20 trillion in underlying property value. So as Kunal talked about infrastructure, there's clearly also a diversification benefit when it comes to commercial real estate. And if you look at that same correlation chart, you'll see that, for example, the property prices, the underlying commercial property prices have a negative correlation of negative 0.4 to the 60-40 portfolio. If you look at the REITs, they have a 0.78 correlation to that 60-40. So this is part of the reason why we want this to be a part of the conversation for portfolios. Now, the reason why today I'm excited to talk about real estate is also this price opportunity within real estate that has been created. And if you go to the next slide, investors have shied away from real estate, I would say, for the last year and a half because property prices have been correcting. But if you look at these charts, you'll actually see that we're starting to have an inflection point in commercial real estate prices. So the left-hand side shows you year-over-year changes in CRE pricing, and then you see that for some sectors, especially like industrial real estate, for example, they're now positive year-over-year. So that's one good part of the story. The other one is that even though there's a positive year-over-year inflection, property prices are still down relative to where they were in the second quarter of 2022. And in aggregate, the prices are down about 10% from where they were. But some of them are down 20%, which is the case with certain office assets. So the reason why I bring this up now is because if we're heading in the environment where the economy does have a soft landing, where net operating income growth can actually hold up as it has been doing, where cap rates can begin moving lower, all of that provides quite a bit of support for commercial real estate. And so the last slide I'll share here with you is the cap rates, which cap rates rise, property prices fall. And you see cap rates have risen quite a bit from the low levels that we've seen, but they have started to also decline as there's talk about the rate cuts and as there's talk about economic stabilization. So I do think this is a very opportune time to be talking about, actually, Kunal, both sides of the commercial real estate balance sheet, equity and credit. So we're going to pause there with the prepared part of our remarks. But Kunal, I actually want to go to you for the first question, which does which is related to commercial real estate. And there was a question that came in on real estate debt in particular, which I know has been a focus for you. But what would you say, it's a two-part question, what would you say the allocators are missing that private real estate debt can provide?
Yep.
I'll leave you with that one first.
Yeah, so look, private real estate debt is right now giving you sort of high single digits in terms of income. It's the same returns as what you get in the CRE core or core plus sort of category. Mm-hmm. So it's a really strong play where as we discussed, the valuations and all the stuff in the real estate market, commercial equity side is going down or staying flat, debt provides that stability again, right? We talk about portfolio diversification and different roles. CRE debt is providing that. The opportunity is even more pronounced given the fact that a lot of the banks are receding. We saw this significant activity from a banking sector perspective in terms of they leaving the CRE sector last year. And there are some pressures. More and more banks are having increased loan loss reserve ratios against commercial real estate, which means that private lenders will take a larger share of that market as well.
Yeah, thank you for that, Kunal. And the second part of that question is, what would you say about the lack of liquidity or lack of transparency when it comes to real estate debt? But, maybe expand that question to private credit broadly.
Yeah, I mean, from our perspective as an investor, the transparency has always been there. And the liquidity issue is you get current income. Most people use this as a bond or fixed income substitute, right? With the intention to just collect coupon, a higher amount of coupon compared to what you get in traditional fixed income. And the markets to sell from a liquidity perspective, so if you own a portfolio of funds in this area, the secondary markets have continued to grow. As we have discussed many times before, we have put out sort of white papers on this. The growth of the secondary market is really important for the growth of overall liquidity in the private markets. And we are very optimistic that that market will continue to grow over the next few years, which will mean that liquidity concerns will ebb over the next few years as well.
Yeah. Kunal, there's another one for you when it comes to, we covered real estate, we covered private credit. Let's talk about private equity. And, look, private equity was down in 2008, but, talk about, what do you think the lack of markdowns in recent years, how they will be impacted in returns going forward? Is there an extend and pretend going on?
Well, look, it all comes on the quality of businesses. Private equity has shown over a long period of time that the companies grow at a faster rate. So if the companies are growing at a faster rate, you don't need to mark the companies down as severely as it is in the public markets. When you're growing at 2-3 times the GDP rate, it's easier for you to maintain your sort of focus and say, I can mark my company a little bit higher than what the public companies do as well. The second element to that is, private equity managers also have a much more proactive way to manage their companies. So unlike public investors who react after earnings are released, private company investors are involved, especially private equity guys who control the company, involved in making decisions much faster. So they take proactive steps to manage the company in a much more active manner. They meet with the board more actively. As a result, we think there's a more valuation stability that comes out of private equity compared to public markets.
Yeah, and if I think about the valuation chart that you showed on private equity, there has been a degree of corrections in private equity valuations. They did peak in 2021, maybe 2022, and we did see a reset in 2023. But it was interesting because when we started to look at those valuations quarter by quarter, we did start to see, those markups, pretty quickly. And so I do think there's been some degree of markdowns and valuation repricing, and you've also seen that in returns. And I think if we were to go back to the quilt chart, we would see a little bit of weakness in private equity. But the point is, private equity did not have to go through the variability the public markets had to go to kind of arrive at where we are today, which is hopefully a soft landing and rate cuts. Okay, Kunal, I'm going to ask you one last one, and Joe, I may have a question for you. We've got to cover infrastructure once again. You made a compelling case for infrastructure, so what would you say is the best way to buy into the infrastructure market? Public, private, real debt, equity, anything you'd say there?
The reality is you buy an asset and you apply the private equity playbook, right? These are not something where you can double your revenues or cash flows overnight. But there's still operating sort of efficiencies that you can capture by being an active owner of the asset, right? That can be in the form of being more capital market savvy. That can be more in the form of expanding your business globally or regionally in specific sectors. And the stability, because to your earlier point, you don't have to worry about ups and downs of public markets. You stay focused, you stay the course, and deliver long-term value by having a goal that you deliver towards.
Right, and of course we do have a similar, again, that quilt chart for infrastructure assets only when we do look at public versus private. On a risk-adjusted basis, private infrastructure has certainly outperformed the 60-40 and some of the public infrastructure assets as well. So, perhaps for investors who dip their toe in both markets, I think both are possible and available, but the two complement each other from the volatility profile. Okay, Joe, one last quick one for you, and that is, you covered a lot within the hedge fund land, but if you were to pick a strategy or two, and I'm not talking about specific names, but macro, multi-strat, equity hedge, what do you think might yield the best results over the coming quarters? Or pick your time horizon.
Yeah, I started my career at a macro hedge fund. In the 90s and in the 90s throughout much of the 2000s. I wouldn't say it was easy to make returns investing in macro, but the opportunity set was there. They never tell you it's easy, but when rates are at zero, you should own a lot of risk assets. When rates are rising, you should probably get out of fixed income. When macroeconomic and geopolitical uncertainties are on the rise, macro investing historically, and we think prospectively, is very well positioned. So that's a tactical investment. If I can give you two answers, I promise to be quick. The multi-strategy absolute return generating funds have continued to prove their value inside client portfolios. So that's almost like a core allocation multi-strategy with a more tactical investment into macro.
Joe, once a macro man, always a macro investor, but thank you for making that compelling case for macro and other hedge funds. Kunal, Joe, Pete, thank you very much for your perspectives. Thank you for a great discussion today. And thank you everyone for joining us today, spending your aftermarket close hour with us. And if you'd like to discuss any of the topics further that we covered today, we're certainly available further to answer any questions that you might have. Reach out to us, reach out to your iCapital contact, or you can always email us at yourquestion@iCapitalNetwork.com. With that, thanks so much for joining us today, and we look forward to speaking with you and our continued partnership. Thank you.